All right, good morning, guys. Rob, I still have 2 minutes. Don't rush me, dang it. Morning, everybody. Hope you're doing well. Guys, my apologies about the volume yesterday. Morning, Gary. Yesterday's YouTube recording didn't have any volume to it. Something changed with my settings. My inputs were off. But everything is fixed and ready to go today, so we're good. Good morning, Jeffrey Dean. Morning, Cav. Good to see ya. Man, I'm usually a couple minutes early, Rob, just because my brain won't allow me to be late. Um, but it happens. It happens. I will be in here and full blown by 9 always. I usually come in a couple minutes early because what happens is when I come in, that's when people start showing up. So if I started a couple minutes early, then people kind of get in and nobody misses anything. That's my thought process. I don't know if it's a good one. Um, who knows? Guys, not a big news week. Or maybe a huge news week, but maybe not affecting the market so much. We do have the WEF annual meetings going on all week. It is a financial meeting that takes place somewhere that's not my living room. That's all I'm sure of. But every now and then they may come in and make announcements to the media based on what's going on. That's why they list it as medium impact, because there could be a spike here and there, but there could always be a spike here and there. So just be on your guard. Everything that I talk about, guys, today, every day, whoops, wrong one. It is all Nexgen website. Good morning, Bob B. the man. And good morning to everybody. Rich people dividing up the world. That's all right. Let's be one of them. How's that? Let's be one of them, Gary. By following rules. Guys, everything that I talk about each and every day, it comes from the Nexgen page. There's no secrets. I don't want to keep secrets from you. I don't want to hold back. But I'm not going to give you everything that you could possibly do with this software as a brand new user. It doesn't make sense. That's overwhelming. That's confusing. So what we're going to do this morning, let me go to my glossary of common terms. Let me scroll down. Sorry for the scroll thing. And we're going to talk about this today. We're going to talk about a high probability trade. This is the exact same trade that I talked about yesterday, and this is the exact same trade that I will talk about tomorrow. Because the high probability trend trade, guys, each indicator on every chart agrees with the rules for the trade. Strongest triggers, no termination conditions, nothing between you and your target. This is your first trade, guys. This is your foundation trade. This is the trade that typically wins 70 to 80% of the time if you follow the rules. This is the trade that, because of that win percentage, creates an awful lot of confidence. You're learning to trust your methodology. You're learning to trust your entries. And most importantly, this is the trade that teaches you to read your charts. And it's fun. I say this every day. Once you can read your charts, guys, you're going to be able to pick out where the market is most likely to continue. That becomes your entry. You're going to understand where the market is likely to go. It's a great spot for exits. And you're going to understand where the market is likely to stop. And that's a great place to not take that next trade. And just a little, when you understand where the market is likely to go, that profits at these areas that could create bounces, guys. You're going to learn to respect these fibs. You're going to learn to be able to see them, to identify them, to embrace them as a support or resistance, and you'll be able to trade to them. And what you're going to find is that 90% of your day is really spent doing nothing. 90% of your day is reading your indicators. 90% of your day is just waiting for the advantages so that you can take a trade. The other 10% will be actively trading. So when we talk about this high probability trend trade, hey, good morning, Steve. Thanks for the heads up on the volume. I got everything fixed for today. when we talk about this high probability trend trade, it's 3 rules, and that's it. Each rule provides an advantage when true, and the recipe for a trade, brand new users, is the accumulation of the advantages. So a trade is momentum through rule number 1, and that is paired with a clear path from rule number 2, and then it's finished off with defining your entry area in rule number 3. And each rule creating advantages is what gets you into the trade. A trade is nothing more than my rules met, because my rules have been proven. And guys, proven is a strong word here. My rules have been proven to win more than they lose. And if you don't put the time and effort in to prove that your pattern wins more than it loses, you're going to have difficulty trusting it. And when you don't trust your rules, you will hesitate, you will arbitrarily move stops, you'll rely on hope more than analysis. So guys, we're going to focus heavily on just identifying the 3, breaking them down, what they mean to you. And I'm going to tell you from 5 years experience, once you can identify momentum, and once you can understand whether or not there's a termination condition present or you have room to your targets, you have everything that you need to be successful with the software. You have everything that you need to create a very solid, confident plan, a consistent plan. If you bypass learning the rules and you only look for the trades, you will spin your wheels for a while. I say that with the utmost confidence. So we're going to break these rules down, where to find them, how to study them, what they mean to you, what they look like. And we're going to use only 2 charts to do it, because it doesn't have to be difficult. It doesn't have to be 3 charts, 4 charts, different time frames. 2 charts is plenty. And just to simplify even further, the most current bar, the bar that prints first, right there on your large chart, that's all it takes to define direction, whether you should be looking for rules to be met to go up or down. It will define momentum, whether or not that rule number 1 is met, and it will define the areas that could be problematic or beneficial, and that's rule number 2. Your first 2 rules, 66% of your advantages, come from the large chart, from the first bar on the large chart. Once these rules are true, once you have momentum, once your path is clear, that's when you go to the second chart. And it's got to be like a flow chart. If it says up, I will look for momentum up. And if I have momentum up, I will look for a clear path. And if I have a clear path, then and only then will I turn my attention to my smaller, faster chart, my refinement chart. The large chart's a very broad stroke of a brush. It's slow moving. It's difficult to see change on. But the small chart gives an x-ray of that 1 bar that's providing those first 2 advantages. And typically inside of that 1 bar, because of the up and down, the fluctuations and the fight in the market, you're going to see 15 to 30 bars. We're going to use that refinement process, and that's how you're going to pinpoint your best of the best entry. That's how you're going to pinpoint where the market is most likely to continue with the trend. And by doing so, it will allow you to reduce risk. It will allow you to increase your profit potential. And that's rule number 3. Rule number 3 is specific to the high probability trend trade, and it is found on the smaller, faster chart. Know where your rules are met, and it'll take a lot of indecision out of the trading. We use these 2 because it's important to remember who you're trading with or who you're trading against. Your big charts define the areas and the direction. The large chart reflects the large crowd opinions of the market. The people that can create trends, that establish momentum, that react at areas, guys. This is the group you want to be trading with. Trading doesn't have to be difficult. It doesn't have to be fight. It can be very much go with the flow. But there's also a small crowd. This is your small chart. And these people tend to push. They push against the large crowd. And they can create these little retracements, these little fights, these pushes down when everything says up, or small retracements up when everything says down. For the sake of the analogy, the small crowd typically fails 70 to 80% of the time. Rule number 3 is designed to pinpoint where their failure is imminent, where their fight is most likely to fail, and that is actually your entry for the highest probability trend trade. And if they're on the wrong side of history 70 to 80% of the time, it means that you have the potential to be winning up to 70 to 80% of the time. So we're going to trade with the large crowd, but we are going to embrace the small crowd's fight so that we can have the least amount of risk and the highest profit potential. So here's our morning. Let me lay it out for you. You guys are going to learn the trigger line and the Fibonacci rules for when it's okay to trade. When it's okay to trade. When is it okay to trade? It's okay to trade when the rules are met. It's not okay to trade when the rules aren't met because you don't have that statistical advantage. You guys have the opportunity to simulate, to get in there, to practice, to practice these trades, to practice these entries, to work on your management, to really practice having the rules met, making sure that you're always following the correct rules, because once again, you're going to prove to yourself that your rules win more than they lose. You're going to create that confidence. The goal is that you don't practice the wrong trades. Now, practicing the wrong trades doesn't mean that you're not going to make a mistake, that you won't accidentally fight a trend or triggers or into a line. It means that you're not just jumping in arbitrarily, that you're not breaking rules intentionally, hoping to create this fictitious simulator money, guys. You're never going to be able to buy a simulator mansion or a simulator Ferrari, and simulator women won't think you're neat. The idea is that you're building muscle memory so that you can always trade those correct rules because they win more than they lose. We're going to simplify. I'm a huge fan of simplification. We will talk about that one trade. Good morning, Erla. You guys need to learn what look you're going to commit to. What's it look like when your rules are met? What is that pattern that's been proven to win more than it loses? And we're going to do all this, guys, and there's a plan. There's the easiest plan to becoming a confident trader ASAP. And it starts with having a little bit of courage. Posting in the room. Everything that you do, post in the room. When you take a trade, post it in the room. Show me your entries. Show me your exits. Talk about your advantages. If you're looking at a chart and you're not sure what you're looking at, post it in the room. Ask that question. Hey, Mark, what is this? What is that? What does this mean to me? Is this a pattern I should be paying attention to? When your rules are not met, take a picture, post it in the room. Say, hey, Mark, I recognize the termination condition. I chose not to trade. We will virtually high five, and you'll move forward just a little bit more. That's the first part, guys. Open yourself up to feedback. As you grow with the software, the easiest way to get to where you want to be is to know what you're doing right and wrong. Good morning, Chef. And that's precisely what the classroom is designed for, is to give you that feedback on everything that you do and everything you see. The second thing is using the spreadsheet. I give this out every day. And whether you use it or not is up to you. But this spreadsheet has 4 tabs on it, and each tab is really equally important. The first tab is just a trade journal. That's all it is. So if you take 10 trades today, you should have 10 pictures of trades. Good morning, Miss Jen. In this spreadsheet. And you should say to yourself, here's my picture, here's my advantages, and here's my feedback from class. And you're not doing this because I want to give you chores or because I want to keep you busy. What I really want is I want you to come back every morning and study these trades. Study the trades that you took yesterday and ask yourself what worked. And ask yourself what didn't work. And look at the feedback section. And you're going to begin to recognize patterns in yourself. You're going to begin to recognize when you're taking the perfect entry over and over. You're going to recognize when maybe you're breaking a rule. And by studying this each and every morning, what you're doing is you're setting yourself up. You're giving yourself a focus for the day. I'm going to focus on what I did great yesterday. But I'm also going to focus on not doing what was hurting me yesterday. So make sure that you're keeping your trade journal. There's a basic rules section. This is the 3 rules of the high probability trend trade in green. What it looks like when they're met. These charts are annotated. There's pictures, there's arrows, there's everything you need to learn these looks. And then there's what it looks like when they're not met. Because if your only 2 options are rules met or rules not met, take a trade, don't take a trade, it's important to know both sides of the coin. There's the client trades, where there's almost 400 pictures of Nexgen users embracing momentum and path and entry. And that's the green section here. Each of these trades belongs to a client, not to Nexgen. So there may be some discrepancies here and there. Don't look at these pictures with your goal being the trade police. Look at these pictures to identify advantages, to see how other people are using the software. Know what's coming for you. There's the entry sequence, short and long. There's a lot on management in here. There's patterns that repeat themselves. Once you're chart reading, you will recognize patterns. Patterns are not rules, though. Chart reads aren't rules. Your chart reading tells you when the rules are met. Don't confuse the two. There's some stuff on NASDAQ. I know there's some people in here that are hell-bent on trading the NASDAQ, and you're struggling. I'll share everything that I've learned in my NASDAQ journey. Well, not everything, but a lot of it, what you need to think about when it's time to look at the NASDAQ. And then finally, the last page, the last tab is where you're going to build your plan. And again, I can't stress enough. Pictures are the way, guys. Pictures are the path. The more pictures you take, the quicker you're going to get to where you want to be. The more you annotate those pictures, the faster you're going to get to where you want to be. The more you share them in the room and go back and share them into your spreadsheet and look at them and study them, that's what's going to get you where you want to be. Very rarely is taking a trade going to be as comprehensive, informative, and advantageous as taking 10 pictures of what it takes to get you into a trade. But as you build your plan, there's a whole section to do it, and then you're going to have to manage. There's a section as you work on your management plan, and there's also patterns that repeat themselves again. Things are going to jump off the page at you. Drop them in the room. Hey, Mark, is this pattern important? But use that spreadsheet, guys. It is such a big part of what we do. So we're going to move forward a little bit, and we're going to start getting into it. If you're brand new with me, I want to remind you, you're not expected to be great at this in a day. It's a lot of information coming at you. Raise your hand if you need help. Post a picture. If you can't post a picture, if you can't take a picture, if you don't know how to annotate a picture, guys, I need you to raise your hand and tell me. We'll go over it. I'm happy to go over it. Everything you need, I will cover. But let's talk about the indicators. What are we looking at? These are the indicators that you're going to see on your charts. This is not rules for a trade. This is not using anything to create advantages. This is just what you're looking at. Here's your roadmap, guys. Every chart has triggers, small triggers and large triggers. They're the same no matter what time frame. Small triggers are 2 solid lines. Large triggers are 2 dashed lines. Good morning, Luciano. Smalls, it takes 2 solid lines to create your small triggers. It takes 2 dashed lines to create your large triggers. And these are going to work together first to define momentum in rule number 1, but we're also going to use them to understand termination conditions. So know the difference between the small and the large, and the relationship between each other and areas is going to come into play. And then areas. What am I looking at on my charts, guys? This is just naming them. There's divergence highs, which are magenta lines, and they will print if there's a loss of momentum at a pivot from a high. So divergence is synonymous with loss of momentum. Fibonacci resistance is a red line, and when the market is trending up, it just may stop, bounce, reverse completely off these lines at times. There's yellow 1-to-1s, there's mid bands, there's Fibonacci support, divergence lows. Guys, this is just a roadmap, and I give this PowerPoint away every day so that you can have these, but make sure you know the terminology, so when I say when price reaches an area, you know what an area is, and when I say where are the trigger lines, you know what you're looking for. So we're going to break it down. We're going to look at each rule and just kind of talk about the advantages and how to identify them. So rule number 1 says that the large chart, remember the large chart leads the way. The large chart must have strong trigger lines because I'm looking for that advantage of momentum. So the large chart will define trend before it defines anything else. The background color on the large chart behind that most current bar, if it's green, it's going up. That's it. I'm looking for rules for high probability trend trades long. And if it's red, it's going down, and I'm looking for rules for high probability trend trades short. The trend is your friend. That's the old cliche. In an uptrend, strong triggers means that my small triggers are up and above the large triggers. My large triggers are wide, and there's space created between the two. There has to be space. I need to see sunlight between those 2 triggers. When that gap is there, when the space is present, when everything is angled up and wide, the odds are favorable for the market to continue up. That is the That's how we describe strong triggers. Odds favorable momentum, because the odds are favorable for it to continue up. In a downtrend, smalls below the large, large or wide, space between. It's really the same look, just inverted. And the odds are favorable for the market to continue down. You guys are going to hear odds favorable momentum, excuse me, all day long. You will see it annotated on charts, OFM, from a lot of people. When I have these strong triggers, the market's likely to continue in the direction of the trend. When I have these strong triggers, that's what it takes typically to break those key Fibonacci areas, to get through them, to go to the next area. And when I have those strong triggers, guys, this is when I'm buying Fibonacci support or selling Fibonacci resistance on that smaller, faster chart to go with the trend. And that one bar endeavor on the large chart, it's going to look like that bar sprouted a tail or a wick. You're going to use that for study. You'll actually use that refinement chart to pinpoint where this tail is most likely to form for a long trade, or where that tail is most likely to form for a short trade. So strong triggers lead the way, guys. Strong triggers are an amazing advantage to have. It's rule number one for a reason. But when your small triggers work their way back inside of the large triggers, we call this a weakening of the large triggers. And when you have weak triggers, anything can happen up or down. When you have weak triggers, this is when Fibonacci areas tend to hold. When you have weak triggers, this is where you tend to see bigger retracements or reversals, even from the middle of nowhere. So brand new users, I encourage you to really have two options as you look at the market. You either have strong triggers, separation, that's exactly what it looks like, or you have weak triggers, smalls inside of the large. And it can be that simple. There is strength. There's one of those tails. There's one of those pullbacks. We'll circle it because we're going to talk about that in a little bit. That was probably a great opportunity to capitalize to make money down. Notice that with the weak triggers, there's a deeper retracement. But it was strength that got us there. And as those triggers begin to weaken, that's where the push-up starts. So, is everybody good? This is rule number one. This is our most current bar. Smalls above the large, space between. On the most current bar right now, ladies and gentlemen, we do in fact have strong triggers. We do have odds favorable momentum. Is everybody good with that? You can give me a Y if you are, especially if you're new. Or you can sit quietly. I'm all right with that too. I'm a fan of everything, guys. Once I have momentum, once that market's pushing, once it has the potential to continue, I have to make sure that I'm not trading into an area. I have to make sure that I'm not trading into a termination condition because I want room to my profit targets. I want that clear path. And a termination condition is a Fibonacci-based indicator. Those are those areas that we looked at, and they may reverse the market based on a comparison of that area and the trigger lines. So the trigger lines, we're not done with them yet. We're going to let them establish momentum, but they're also going to tell us the status of the areas that we've gotten to. And these areas can be Fibonacci support or resistance, yellow 1-to-1s, divergence highs and lows. It could be three divergences in the same price range, or even that large chart mid-band if the triggers are a full bar away, the large triggers are a full bar away. So know the lines that qualify. It's not just fibs. It's fibs, 1-to-1s, divergences. So know which lines can be termination conditions. And remember that these lines are where the large crowd typically reacts, where they make decisions, where they enter, where they exit, where they fight. So the recipe to identify a termination condition, it's not a difficult one. It starts with price reaching the area. Your dynamic Renko bars push up and they hit Fibonacci resistance, or they hit that divergence high, or they hit those yellow 1-to-1s. When price reaches resistance, the only thing that you have to do is say, where are my triggers? And then answer that question. Where are my triggers? My triggers have remained below resistance. Small and large are below resistance. Resistance is a termination condition. Resistance is an area that could bounce, could create an untradeable bounce. There could be a fight right at that key area. That you see up, down, up, down, up, down, up, down. It could break and the market could continue up, Or it could create a reversal, which means those large triggers went from green to red on you. And the reality is you'll never know. You'll just never know what the reaction's going to be. You'll never know if it's going to go up or down, whether it's going to break or bounce. So when price reaches an area and the triggers remain below resistance, rule number 2 is not met. No trades into that area. This is your patience piece. This is your 90%. Waiting for the reaction, guys. And if the reaction is it breaks, we'll look for trend trades again. And if it holds and reverses, we're going to call that a strong top, and you'll start looking for your rules to be met going the other direction. And the same is true. The market comes down and it reaches Fibonacci support. It reaches yellow 1-to-1s, a divergence low. Once price reaches an area, guys, we're done with price. Price has absolutely no role in termination conditions beyond actually reaching the area, setting off the decision making. The triggers tell the story. And if the triggers remain above support, support's a termination condition. It could bounce. It could reverse, becoming a strong bottom. It could create a fight, or it could break. And guys, areas break all the time. But when price reaches an area, look at this, divergence low and the triggers don't break, your advantage is gone. And look at the retracement. And straight to resistance, even with odds favorable momentum, the triggers don't break and resistance held. And it pushes down and support holds. You guys, look at that. There's that odds favorable momentum and one of those darn tails sprouted again. We'll go back and see if that turned into an entry. But even in this little, what is that, 2.5 hour section, once, twice, thrice, four times, rule number 2 keeps you out of trouble. 4 times, rule number 2 keeps you from giving away your cash. So, price reaches an area, where are my triggers? Triggers don't break, don't trade. Don't trade into that area. Wait for the reaction, guys. It's either going to break or it's going to roll. This is what it looks like when areas break. And I made these specifically because this is really, anytime an area doesn't hold, this is what's going to happen. Price is going to reach the area. That's number 1. The triggers remain below resistance. It is a termination condition. Even if it's for 3 seconds, it is a termination condition. I won't take a trade into that area. If my small triggers smash through the area, but my large triggers remain below, this is what we call a 50-50 look, guys. And this is your second trade opportunity after the high probability trend trade. Because this look, smalls through, large lagging, with odds favorable momentum, means that this area does have the potential to break. But it's not broken. It's not broken until both the small triggers and the large triggers get above resistance, both lines of each. But once I'm above resistance, and that area is broken, resistance behaves as support, but my path is clear. Rule number 2 is met until I reach the next line. This is it. It's stop, pause, and make sure that your rules are met. Man, let's look for rules to get into that market. Let's look for an entry. And the same happens going south, guys. Price reaches support and the triggers remain above, whether it is an hour or a second. It is a termination condition. Absolutely no trades into that area. With all that momentum, when the triggers dissect, 50-50, it has the potential to break. There are opportunities. They will have to be managed assertively because your path isn't quite clear. And once the small and large get below support, guys, support is broken and it becomes resistance, and you're looking for your entries to get into that high probability trend trade. Termination conditions, guys. Look at that. We're right into one. Even with odds favorable momentum. And you're going to say to yourself, well, look at that momentum. It should break. Has anyone ever done that? Look at that momentum. That area has to break. Well, you had that same momentum into resistance here, and you had that same momentum into support here, guys. And it's not the one time that it breaks, right? And you miss the trade and you're like, oh man, that stinks. I need to trade into every one of these termination conditions. I love this one. This is an 11-hour period in crude oil. 36 times, rule number 2, stop the market and produced a loser. 6 times you won. So these rules are developed not based off of one instance or 10 instances or 100 instances. Guys, rule number 2 came into play because over 28 years of teaching people to day trade, The likelihood of an area holding rather than breaking when the triggers haven't broken is you're more likely to lose than you are to win, which means that there's not an advantage, which means that you got to pump the brakes and you have to pause and you have to wait for it. Yeah, Chef, rule number 2 is the most broken rule among users. Rule number 2 is the one that takes the most money out of people's accounts because you're relying on hope rather than advantages, guys. And there will be times when your path isn't clear because areas are stacked a bit. It might be fib after fib after fib, right? Or divergence and fib and one-to-one, whatever the combination is. I have 3 areas of support in a row, and I can't seem to get a clear path, guys. This is 90% of your day. Rule number 2 is the patience rule. Rule number 2 is going to keep you out of trouble, but it's also going to keep you out of the market. And that's okay. It's okay to do nothing. The futures markets trade billions every day, and it's not necessary to be in every move, guys. The easiest moves, the highest probability moves, the most advantageous money-producing moves are when you've cleared an area and you're trading to an area. And it's that space in between that pays dividends away from those decision-making points. So that's rule number 2, guys. Can you give me a why in the room? Price reaches, where are my triggers? That's it. That's the whole recipe for keeping you out of trouble. When you have momentum, when you have strong triggers, large chart. When there's no termination conditions, large chart, guys. The large crowd is giving you everything you need to look for an entry. And you're going to go to that smaller chart, that faster chart, that refinement chart. And there is one time on that small chart where rule number 2 isn't met. There's only one instance on a small chart where I won't look for an entry because my path isn't clear. And that's 3 divergences in the same price range. It may terminate the trend. Remember that divergence is synonymous with loss of momentum. So what you're looking at is 3 losses of momentum in the same price range. 3 times momentum wouldn't follow price. And this can stop a market. It becomes more powerful with weak triggers, smalls inside of the large. That same lesson from rule number 1. And it's more powerful still if that third pivot's higher than the previous from a low, lower than the previous from a high. And that is enough to keep me out of a trade. So Dima, same price range. Let's use the exact same recipe that we used for areas breaking. If my smalls and large don't get below, see how the smalls and large didn't get below this one or this one? And they're still in that range. So let's use that exact same recipe. And then let me show you on a small chart. Here's the divergence. Once the small and large get below it, this divergence is the rear view mirror. This isn't my second divergence. The count starts over. There's 1 divergence, 2 divergence, 3 divergence, and sure enough, it pushes up higher. So we're going to let the triggers break. 1 divergence, 2 divergence, smalls and large get below, it's reset. Does that make sense? Does that work? Awesome, you're welcome. That's the only time when I have momentum and clear path on a large chart that I'll choose not to take that entry. You can also use this if you're in a short trade. In a third divergence prints, it's all right to get the hell out of that trade because now you're seeing that change on a small chart that you can't see on the large chart. But if there is not 3 divergences, my large chart says up. My large chart says strength and momentum. My large chart says clear path. I'm going to go to my small chart. Rule number 3 is all about precision. Rule number 3 is all about minimizing risk, guys. And your entry is so precise that you'll use a limit order to buy or sell a pullback at areas inside of triggers. You'll literally wait for the market to come to you. And you're waiting at areas. Areas produce bounces. The same way they can produce a bounce as a termination, they can give you something for the market to bounce off of to continue in the direction of the trend. The key to this entry, and I think where the magic really happens, is that you insist that those areas are inside of triggers, guys, because triggers have this amazing effect. Price returns to the large triggers. So price tends to pull away from the triggers, you can see it, and it snaps back, and it pulls away, and it comes back to the large triggers, and it pulls away, and it comes back, pulls away, comes back. Price returns to the large triggers. Well, there's large triggers on the large chart, and there's also large triggers on the small chart. And what these trigger lines are going to do for you is on your entry chart. This is your 5-1, your entry chart. Price may return to the 5-1 large triggers. Price may also return to the 13-2 large triggers. So you have what's called large, the smooth triggers, and synthetic, the stepped triggers on your entry chart. And what these are going to do for you is they are going to define where the retracement is most likely to occur. When that small crowd starts fighting, trigger lines define where price may return. It's your retracement zone. And this retracement zone gets smaller and smaller if you insist on having what we call favorable large triggers. And favorable large triggers mean that the large and synthetic are one on top of the other. They're overlapping. They're like two snakes riding piggyback. And your retracement, where price is most likely to return, is the smallest possible area. And this is going to help reduce risk. This is going to increase precision. And then when you shoehorn some areas in there, fibs, mid-bands, yellow 1-to-1s, you've got an area for a bounce right in the middle of where price is most likely to retrace, guys. This is the precision of your entry rules. So let's go through it step by step. This is your small chart. I've covered the large chart because the rules are met on the large chart. We don't need it anymore. The first thing that I need on a small chart is I need that small crowd to fight. I need a pullback. I need some down movement, even though everything is going up. That's the reversal bar. The reversal bar signals the beginning of the pullback. The reversal bar is not your entry, and it's not uncommon. You're like, oh, reversal bar, buy now. It's not the plan. The plan is once this prints, and you'll learn how to anticipate it as the market's going up, you need to figure out where's the market most likely to retrace. Where are these price bars likely to go down to? That's your large triggers, your synthetic triggers. And one's not more important than the other, guys. So you're going to build a box. Mentally, you can do it physically from the lowest line of the triggers to the highest line of the triggers, guys. This represents where the market is most likely to retrace. And the tighter they are on top of each other, the smaller that area becomes. That helps with accuracy. Triggers aren't bouncy. Triggers aren't solid. We need something for the market to bounce off of, guys. And this is where the precision really plays in. We need areas inside of triggers. And areas can be fibs, mid-bands, or yellow 1-to-1s. But they have to be inside of triggers. Notice that I put inside of triggers. Inside of triggers, this is such an important part of what we're doing. And what we've done here is this box from the highest point of support to the lowest point of support, it shows me where the market is most likely to bounce in the direction of the trend from the large chart. It shows me where the small crowd is most likely to fail. This right here is where we're going to look to enter the market. But because the large chart has odds favorable momentum, because the large chart has absolutely nothing in the way to create a bounce, you're going to activate a limit order. You're going to right-click on your small chart, and you're going to create a buy limit for this particular trade, and you're going to put it about 2 ticks above the highest point of support. Don't trip over pennies trying to save a couple dollars, guys. You've done all you can do. You've insisted on momentum. You've assured that your path is clear, and you have pinpointed with pretty amazing accuracy where the market is most likely to continue in the direction of that trend. All you need now is for the market to come get you, guys. And if they do, guess what? If price pulls down and hits your limit order, you're in a long position. And you're not just in a long position hoping the market goes up. You're in a long position with the advantage of odds favorable momentum. And you're in a position with the advantage of nothing in the way on the large chart to create a bounce. No reaction in the areas. and you're in a long position having entered exactly where the market is most likely to continue. And guys, this is your high probability trend trade entry. And this is all we've talked about so far today, is identifying advantages on a large chart and refining that one bar into an entry. So learn the recipe for defining your entry, guys. It all begins with the reversal bar. The reversal bar begins the pullback. That's the fight from the small crowd. However you want to say it, that makes you feel good about it. The reversal bar is not your entry. But the reversal bar tells you where is the retracement most likely to happen. Go find those trigger lines, large and synthetic. Could be either. And that red box signifies where the retracement is most likely to occur. The trigger lines are not your entry. Your entry comes from an area inside of trigger lines. So from the highest point of support to the lowest point of support inside of triggers, all caps rattling around in your brain, this is where the market is most likely to continue with the trend. This is where the small crowd is most likely to fail. Because of the advantages on the large chart, your job is to activate a limit order, a tick or two above that highest point of support. And wait. And it's either going to come to you or it's not, guys. And by defining where the market is most likely to continue, you understand where the market shouldn't go. Any line, any fib, any midband, any yellow 1-to-1 outside of the triggers, outside of the window. Guys, this is not a part of the entry equation. And if you're below the triggers, this is where the market should not go. You're actually going to use this for stop placement. And God bless futures, we can make it both directions. When the market is trending down, when the momentum is strong, when the path is clear, your job is to go to that smaller, faster chart, wait for a reversal bar. That reversal bar lets you know the fight is on, the retracement is imminent. Where's that retracement most likely to go? From the bottom of the triggers to the top of the triggers, somewhere in there. But the triggers aren't my entry. I need an area. I need something solid. I need a brick wall to throw that tennis ball against. This midband, the only line inside of favorable large triggers, guys, this is your entry. This is where the market is most likely to continue, where the small crowd is most likely to fail. And all you need to do is activate a limit order, a couple ticks below that area of resistance. And this is your entry for the highest probability trend trade. You understand where the market is most likely to continue, where it's most likely to retrace, and now you know where the market shouldn't go. It shouldn't go. It shouldn't go to the wrong side of those triggers. It shouldn't go beyond those areas inside of triggers. This is where the market should not go. Bob, it just clicked. Have not even tried sim trading because you didn't get it. But you get it. Complexity with some... Oh, I love it. Now you just have to practice it, Bob. And I'm going to give you a way to go back and practice a little bit. We'll do that. We'll focus on entries today so that it clicks a little harder. Guys, your initial stop is going to go where the market should not. And I love that phrase. Where's my stop go? Where the market shouldn't. Well, what's the number? The number's different for every trade. But once you identify where the market is most likely to retrace, where it's most likely to bounce, where it's most likely to continue with the trend, your initial stop will go 4 or 5 ticks above those triggers for a short, 4 or 5 ticks below those triggers for a long, because that's where the market should not go. That's where my advantage is gone. And I'm going to let you in on a secret, guys. Write this down on a piece of paper. Everybody get a big Sharpie and some poster board. And write down anything that wins 70 to 80% of the time will lose 20 to 30% of the time. 20 to 30% of the time, my stop's going to get hit in high probability trend trades. I don't get to pick which 2 or 3 out of every 10 it does. So I have to be consistent in following my rules. I have to be consistent in my entries, and I have to be consistent in my stop placement. This is a cost of doing business, but that really helps reduce risk. Even more so, with all those advantages, I'm more likely to get a reversal bar off that area and the direction of my trend. We call that a confirmation bar when the rules are met. And you'll be able to reduce risk 2 ticks below it for a long, 2 ticks above it for a short. And it's not uncommon to take one of those 20 to 30%, to take a loser but only give up 3 or 4 ticks because your entry was so precise. Because the market tried to push with all those advantages, you reduce your risk, and sometimes they will come back and get you, and you'll take a tiny little loser. And guys, small losers are amazing. Small losers are just normal. They're a part of it. That's what happens. And I have zero hesitation telling you that every trade won't be a winner. In fact, I don't think I've ever met anybody whose every trade was a winner. But this is your entry per the rules. There's your reversal bar. Look at how small the risk is between entry to reversal. This one didn't work. That's a tiny little hickey. And it doesn't hurt to take small losses. So we've talked about the advantages individually. We've broken them down one by one. The advantage of momentum. Small's above the large are wide, everything's going up, the space is there. The odds are favorable for this market to continue up. Smalls have smashed through, the momentum is present. The large haven't quite made it, and this one has the potential to break, but it's not completely broken yet. But this is an outstanding look. If I go to my small chart, you'll notice that price pulled back to support inside of favorable large triggers. Let me give you a glimpse in the refinement. This one bar right here on the large chart, from head to tail, is all of these bars on the small chart. This is why we don't trade tails, we trade pullbacks. That's where the least amount of risk comes in. But you can use these tails to study, to go back and commit a little, or get a little faith in what we're looking at. So if you circle the tail on a large chart, and you can scroll back historically, you have 10 days of data on every market, every workspace you own. When the rules are met, circle the tail. Does it fit the rules for entry? Did it come from an area within that retracement zone? If it did, you're starting to learn your patterns. So this looks exactly like it, doesn't it? Odds favorable, potential to break. There's the retracement. And if we break this down, the market might retrace really in this zone here. And that's a huge zone, right? Because it's not favorable large triggers. They're split. The highest area is a midband. The lowest area is support. And guys, the reality is my stop would have to go somewhere down here. That's a tremendous amount of risk. Can we agree on that? That $200 per contract is a lot? Hoping an area breaks? It should. That's exactly what you should say to yourself. Guys, you can use this up bar right here. When the risk is so big that you're not comfortable with it, you can wait for confirmation. You can wait for that reversal bar. And that means now your risk is established 2 ticks below it. When my entry isn't perfect, I love waiting for confirmation, guys. When my entry isn't perfect, it's okay to insist that the market go in the direction of your trade. That wasn't the picture I was looking for. Hold on. Jen gave us a great example. The entry wasn't perfect in this one. There was a big split. This is almost exactly what we're looking at, if it's not exactly what we're looking at. Jen said, it could go from here, it could go from here, it could go from here, but my stop has to go here, and I'm not good with that. And notice that she waits for the confirmation bar, and then she enters the trade. If your entry isn't perfect, it's okay to insist on confirmation. That's your right. You can do it. So let's go back and see if we can find another one of those tails, just for grins. And Bob, this is how it's all going to start to click to you. Momentum, everything down, life is good. Let's scroll back on a smaller, faster chart and see what it looked like. Right back to resistance, right inside of the triggers. Do you guys see it? That's your pattern. From the lowest point of the triggers to the highest point of the triggers. And look at the refinement process. Let's make this huge. You know what? Let's go through an entry together. What do you say? Let's take off our cheater. This is your look. Does everybody see? Awesome momentum, potential to break. Life is good. Everything's going south. This is a market that's likely to continue down with that momentum and the potential to break. This is step one. Large chart has to lead the way. Once it does, I turn my attention to the smaller, faster chart. Do you guys remember? What are we waiting for on that smaller, faster chart to start the process? Everything's going down. It's going down, and I feel like I'm missing out, and it's going down, and I'm scared, and it's going down, and I'm not getting paid, and it's going down, and I'm so worried. And then the fight. And then the small crowd shows up, and they say, hey, guess what? We're here, and we want this thing to go up. Your job is to define from the lowest point of the triggers to the highest point of the triggers. This is where the retracement is most likely to occur. This is where the small crowd is most likely to be able to push up. Is everybody with me so far? This isn't my entry zone. That's ridiculous. That's huge. So from the lowest point of resistance inside of triggers to the highest point of resistance inside of triggers. This box represents where the small crowd is most likely to fail. This box represents where the market is most likely to continue down. My job is to right click and put a sell limit, a tick or two below. That's it. That's the whole shebang. And if the small crowd gets to it, guess what? I'm short. I'm in a position. I'm there. That's it. My stop has to go where the market should not. And guys, you know where your stop is going to be every time you enter the market. It's 4 or 5 ticks above those triggers. You know exactly where your risk is. And the market goes up and it continues into that other area. And you will be terrified to watch that market go against you. You're still in the zone, guys. You're still in the window. You're still where it's most likely to continue. And it goes all the way up to resistance, and then it gives you a reversal bar. It gives you confirmation, and your risk goes from up here to just above that reversal bar. And you're in that trade, and you're in that market, and down it goes. And what a beautiful, beautiful trade. And look at this. That box right on top of the peak, right at resistance, right inside of triggers. Hold on. Boom. Right at the top of that tail. So guys, you can study this without ever having to take a trade. You could literally go through it like that, guys. You could see this tail, and you can single click your way through the process to make sure that you understand it, that you can identify it, that you're good with it. And you can do it on every market you own a chart for. So let's go see if we can find one. We'll get that one since it didn't hit the area yet. That had the potential to break. And let's scroll back to 716 and see what it looked like. Whoa, I went right by it. What do we think? Mid-band? Right in the retracement area? Room to the target? There it is. All right, so that's my first hour. That's my first hour every hour. And I tell you every day, I'm going to give you everything you need to be successful with this software. And I'm going to give it to you today. And I'm not going to hold back. And everything begins with chart reading, ladies and gentlemen. And I can't stress this enough. To get to where you want to be, you have to be able to recognize some looks and patterns quickly. And this reinforces the lessons, guys. And it speeds up the process of becoming a chart reader. And you're going to need that chart reading to know if your rules are met. You're going to need that chart reading to manage trades. So, take pictures. Take pictures of strong triggers, weak triggers, clear path, termination, and entries. Go through and just be a shutterbug. Take those pictures, guys. But the task isn't just to take them. It's not just about taking a picture and deciding, oh, I'll commit this picture to memory. Go through and annotate those pictures. Talk about the whys. Why is it strong triggers? What is the advantage? What does it mean to me? What rule does it line up with? Why is it a termination condition? What's the formula for defining a termination condition? What's the disadvantage? And guys, this is what the 101, the basic rules section is for you. Because if you take a picture of strong triggers, let's just click on one of the pictures. And you say strong triggers, small above large, all green, momentum rule 1, and you draw an arrow to it. Does anyone think that they could take 25 pictures of this and make a mistake on whether or not they have strong triggers or weak triggers? Do you suppose you could take a picture and say small inside a large, weak triggers, anything can happen, rule number 1 not met, and ever make the mistake of confusing strength with weakness? I don't think it's possible. I think at this point, the only way you'll trade without strength is if you make the choice to trade without strength. So go through and do that. Now I'm going to give you this, and I'm going to tell you right now, the most pictures finds the most success the fastest. You also are going to get the high probability trend trade checklist, and it is exactly what the title suggests. It's a checklist for the high probability trend trade. Is the market coming from a strong top or bottom? Was there a no triggers through termination that reversed the market? If there was, mark yes. It's a flow chart. It's not mandatory, guys, but it definitely adds some warm fuzzies to this trade if I'm coming from a strong bottom or a strong top. Do I have odds favorable momentum? That's odds favorable momentum to the upside. There it is to the downside. It should never look like that. Am I trading into a termination condition? Does it only have the potential to break, or is it actually broken? Know what you're getting into so you know how to manage it. How do I get into the market? My limit order goes a tick or two below the area of resistance inside of favorable large triggers. My entry order goes a tick or two above the area of support inside of favorable large triggers. My stop will be where the market shouldn't go. And then there's the checklist for you right there. Print out the second page, laminate it, get a dry erase marker, save some trees. But if you go through, every time you take a trade, if you're running through this either in your brain, looking at the checklist, guys, it's going to keep you on the right side of things more often. I've never had anybody in the history of this checklist do worse than 70% with it. Ever. Nobody's ever presented an instance where they've done worse than 70%. Most were in the 80s. This is your first trade. And all we've done is talked about entries, right? So I'm going to give you a plan as well. I'm going to give you the KISS plan. And the KISS plan is a stepping stone in your learning journey. And it's designed to optimize your chances of success with a high probability trend trade. And it will be through simulation, study, class feedback, and continuous practice. You will craft a plan tailored to your personal goals based on your experience reading the indicators. Once you're a chart reader, you're going to see things. You're going to find opportunities. Once you build that foundation, you're going to grow from it, guys. The high probability trend trade, and I love this. This is not your only trade. This is not your get-rich trade. This is the one that allows you to see it. This is the one that teaches you to read your indicators so you can find those other opportunities. Your simple plan for consistency is don't fight the large chart. Don't fight the large crowd, guys. Don't fight the trend. Don't fight momentum. Don't trade into areas. Respect that the large crowd is leading the way. If you can do that, you're going to eliminate about 70% of the mistakes that the typical trader makes. And then you have to define your entry. Why? Because great entries create manageable trades. Because great entries reduce risk. Because great entries maximize profit potential, guys. And it's got to be your entry. Trading is a solo sport. So what's it going to take to get you in the market? The only way I will enter the market is if my rules are met. And if they're not, I choose to sit on my hands and do nothing. Because avoidable losses are just big, ugly speed bumps. Mountains you have to climb that wasn't necessary to climb. So define your entry. And then manage it. Management can be terrifying. Once you go live, management means you have something to lose. Management means that your money can be taken away, that your profits might not be reached. Management is what gives us sweaty palms and anxiety, guys. It's true. Entries are easy. It's so easy to enter the market. All you got to do is push a button. And then management requires that you don't push that button. that you let the trade do what the trade does. So in the KISS plan here, the management plan is very, very mechanical. Once again, it's a flow chart. If then, if I have this, then I'll do that. And you will craft a management plan. You'll create a management plan tailored to your personal goals based on your experience reading the indicators. And guys, there's so many schools of thought on management. Everybody has different pain tolerances. My brother and I have very different pain tolerances. He hates quick profits. I love quick profits. He likes holding for bigger moves. I don't care if I hit the bigger move because I know that the next trade is coming. You'll figure out what your style is. But this management plan is very mechanical, and it is designed, and see, everybody's different, right, Paul? I like to get paid. It is designed 100% to get you paid ASAP and to know where to put your stops while you're getting paid. So your management plan, the first part of it is getting in at the area where the market is most likely to continue. Is giving yourself that highest chance of success, that least amount of risk, the most space to your target, guys. And if I enter where the market is most likely to continue, then my stop goes 4 or 5 ticks below those triggers. And then that's it. That's the end of it until the next if. So I'm either going to get stopped out. This is a cost of doing business, guys. This is a very normal part of a positive equity curve. I think I'm at 33% winners right now today. I've taken 3 trades today and I lost 2 of them. I lost my first 2 trades. But my rules were met again and I took it and I made it all back plus $100, guys. That's what trading is. If my stop doesn't get hit, well then I probably got one of those reversal bars in the direction of my trade, one of those confirmation bars. So if I get a reversal bar in the direction of my trade, then my new stop is 2 ticks below that reversal bar. And once again, there's nothing to do. I have to sit on my hands. It's either going to hit my first target, and guys, this is a 2-contract scenario. I'm in 2 contracts long. It's either going to hit my target or I'm going to take a much smaller loss than my original would have been. With all of those advantages, with momentum, with path, with areas inside of favorable large triggers, it's really not that difficult to hit your first target. Remember, the KISS plan is designed to get you paid, guys. Your first target is $100 away from entry. $100, 8 ticks in the S&P, 10 ticks in crude oil or gold, guys. And that $100 feels good. That $100 creates confidence. That $100 is yours. They can't take it back. And that $100, if I hit a $100 target, if I take off that first contract, then my new stop is break even. I will leave absolutely no risk on that trade as a brand new user because I'm learning to believe, I'm learning to trust that the only reason I'm long in the first place is because I had odds favorable momentum and nothing in the way to create a bounce, guys. And I'm going to go break even. Is it my best stop? Probably not. And you will craft a plan tailored to your personal goals based on your experience reading the indicators. I usually don't go break even after my first profits. I leave a little something on there. But if I've already made 100, I can risk 80 and still come out positive on this trade even if everything goes wrong. But as a brand new user, let's go break even. Let's take all the stress out. And you're either going to get stopped out break even or it's going to go to your second target. And your second target in the KISS plan is $200 away from your entry. That's it. $200. Which means that 2 contracts, 1 trade, all the advantages. You just made $300. Which means that you're setting yourself up to be on pace for a $75,000 year if that's the best you do every day. 75 grand. From 1 crappy little trend trade that only made it $200 away from the entry, guys. Throw in a break even, you're in 6 figures. And there's no doubt in my mind that if you're in this room and you are paying attention and you're looking at other people's charts too, you know that the potential with the software goes well above $200, $300 a day a contract, right? All you got to do is figure out how to do it. You got to figure out what it's going to take to get you in. And even more importantly, once you decide to go live, You got to make sure you know what it's going to take to get you out too. You've got to have a solid plan, and that's what I've just given you. Why will you enter a trade? Because a pattern is present that has been proven to win more than it loses. That should be the only reason to ever enter the market. Your gut will lie to you. Why will I exit my trade? I'll exit my trade because my advantage is gone. Whether it's 5 ticks below the triggers, whether it's 3 divergences in my way, that's the only thing that gets me out of a trade, unless my targets are hit, guys. And rules help remove the emotion, both entry and exit. Having a very solid plan helps remove the emotion, helps remove the opinion. And the great thing is, and this is why I say proven, 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 proven. If you have done the study to prove that your pattern wins more than it loses, guys, those rules keep you from having to know what's going to happen next. Because your rules have stated, if you take 100 trades, you're likely to win 70 of them. You're likely to lose 30 of them. And trading plans aren't built around 1, 2, 3 instances. They're built around a sample, guys. And if you know that it wins 70 to 80% of the time, why would you ever bet against it? Why would you hesitate? Your rules let you know that you don't have to know what's going to happen next, but you know what's likely to happen most often. So if I'm getting into a high probability trend trade, I have a solid plan to get me in. I have a very simple plan to get me out initially, but it will grow as I grow. If I choose to add that 50-50 trade, that second trade, that medium probability trade, there's different rules for entry. And there's different rules for exit, which means that I better not have to think about any of these things. These need to be automatic so I can add something to it. The same is true for momentum trades, for HVA trades, for white bar trades, for that chili dog trade you see people taking, guys. The more you add, the more you have to think about what you're looking at. So keep it simple in the beginning. Keep it very simple in the beginning. And then the key to all this is having a foundation. This is the last thing I share before our first break. So for you new users, you are blanketed with very conservative rules. You are blanketed with don't fight momentum, don't trade into areas. Your entry has to be in an area inside of favorable large triggers. It's designed to keep you safe and increase the likelihood of success. That's it. Guys, those things aren't always bad. They're not always detrimental. There's times where you'll say, man, I've got so many advantages, I'm willing to fudge this one a little bit. I'm willing to adjust my approach and manage aggressively. That's okay. That's what happens with trading. But you've got to learn the process that yields results. You've got to be okay keeping it simple in the beginning. You've got to be okay talking about advantages and really talking out loud about those advantages. And the further you deviate from simplicity, the longer it's probably going to take you to get to where you want to be. That's been my experience in the last 5 years of teaching people to read indicators. And honestly, that's been Nexgen's experience the last 28 years of teaching people to do it. Question everything. Can't stress that enough. Question everything. I don't know what this is. Guys, don't you ever suffer in silence. Raise your hand, type it in the room, get the answers that you need to be comfortable. Study. Get the answers you need to be comfortable. So I'm going to go back and I'm going to remind you. My promise was that you get everything that you need to be successful with the software before this day is over, guys. And I've created a zip file called All You Need. Every document that I just presented to you, Chart Reading 101, High Probability Trend Trade Checklist, KISS Plan, Entry and Exit Conditions, Daily Goals. There's even a very simple approach to the trend trade that I wrote up a week or two ago for some new users. Everything that I just taught in the first hour summarized in 2 pages. Simplicity. And then that's all in the room. You got my spreadsheet. There it is again. The PowerPoint I used to teach is inside of that zip file, guys. Take it, download it, use it. And as we go into the second hour, what we're going to do is we're going to start focusing on your pictures. We're going to start focusing on your chart reads. We're going to look at your entries, your exits. And I'm not going to beat you up if you broke a rule. I'm going to talk to you about how to fix it. If you had too much risk because your stop's kind of wonky, we're going to talk about how to fix it, how to do it better, how to read your indicators more effectively, how to have the least amount of risk and the most amount of profit potential on every trade posted in this room, no matter what kind of trade it is. We'll talk about momentum, a clear path, and an entry on all of them. And I'll give you everything I have in my brain to help out. And then I wrote this up this morning, guys. I got one more thing I want to share, and then I'm going to disappear for just a couple minutes. Where did it go? Taking pictures. Can't overstate the importance of taking pictures, guys. And these are the pictures you can take. You can take as many as you want. These are the pictures that I take pretty much every trade that I take, guys. I take a pre-trade picture. So when I set my limit order, I take a picture. And I don't annotate the picture right there in the moment, guys. I'm focused on my trading, but I will go back and look at that picture, especially if it's a loser, to make sure that I didn't miss anything in my analysis, to make sure that I didn't accidentally trade into a termination, or maybe there was a third divergence that I didn't recognize, because I'm human, I make mistakes. But now I've got a picture before I enter that trade to make sure I can police myself a little bit. I take pictures during the trades. I think my record of a during trade picture is probably like 7 or 8 pictures, guys. I take pictures when I move my stops. I take pictures after targets are hit. I take pictures if things look like they're changing. And the more trades you take during a trade, the more you're going to build a management plan, because you've got that play-by-play. I do take a picture after the trade. I always take a picture that shows my entry all the way to my exit. Did I exit too soon? Did I exit too early? Did I have a reason to exit? Did I have a reason to move my stops, guys? And then I'll go back and annotate this after. And this is the one that I love seeing in the room. And I take this trade too, guys. I took one this morning. The no trade picture. The no longs in areas that haven't, like reminding myself what I'm looking for. Hey, that doesn't fit my rules. Instead of taking a trade and hoping, let me take a picture and talk about my advantages. Jen is famous for these pictures. We saw a couple of them yesterday too. I love these pictures, guys. They will help keep you out of trouble. Pictures 3 and 4, the best ones to put into class, guys. Showing your start to finish, and then share with me the reason that you didn't take a trade. Because your start to finish is where you're going to get all the feedback and you're going to learn how to do it better. And then your no trade pictures, and this is important, and it was my no trade pictures that made me a better trader, because I would take a picture and I would show it to John Novak and I'd say, oh, I couldn't take this trade because. And maybe my because was, hold on. Maybe my because was, well, John, there was a termination condition right here. I can't trade back into those one-to-ones. They could stop the market. And I think this is a because for everybody at some point, because we forget that termination conditions are defined on a large chart. And guys, I needed to present my no trade picture to John Novak to get the feedback to remind me that this isn't enough to keep me out of a trade. It has to happen on a large chart, and this is an amazing opportunity to get to that trouble. And I bet everybody in this room has done that, has let the small chart talk them out of a trade. So that no trade picture, guys, there may have been a trade there. So that's something that I wrote this morning. I was just thinking about it, and I was actually inspired by the pictures you guys posted in the room to write it. But that's a great reminder. Get those pictures going, guys. There's odds favorable momentum in the S&P. If I got a reverse, well, dang it, there's a termination condition in the S&P. Good morning, 10K. Great to see you, man. I'm going to take 5 minutes, ladies and gentlemen. I'm going to go stretch my leg and refill my water and high-five my wife because of the blizzard here in Austin. All inch of snow that we got, the city is shut down and she's working from home. So I'll be back in about 4 or 5 minutes, guys. When I come back, we're going to look at every picture that's been posted. We're going to answer every question that you could have. And Steve Diego, don't let me get away with not talking about the NASDAQ today, because I did screw up the video yesterday. I'll be back in about 5, guys. All right, cool kids. We're going to get back to it. I'm going to scroll up to the very top of the room. Just for those of you that are kind of new, this is how I do it. I scroll up to the top. I will go through every picture in the order that it was submitted. Just a reminder, guys, there is no right or wrong. I mean, there's rules met and rules not met, but in a learning process, everything is valuable. Every picture is valuable. Everything you say is valuable. Everything you do is valuable because there's going to be something to be learned from it. So we're going to go through and we're just going to start. And Jen got us going this morning. And she says, this is not a strong top. This is not a no triggers through termination that reversed the market. And as the market's coming down, there's one of those potentials to break. Odds favorable momentum. And this is what I like, and I think this is the picture that I was looking for earlier that I clicked on the wrong one. And guys, the annotation lets me know what's going through your brain. Jen says, entered once I received confirmation from a reversal bar. As rule 1 and 2 on 50-50 trade not met. So she knows that the very basic, the highest chance of success for this 50-50 look, that potential to break look, is coming from a strong top. And no divergence. And Jen said, you know what? It's a great look. The momentum is great. The potential is there. But let me force the market to go in the direction of my trade before I enter. And what this does is if it doesn't break and the market just cruises right up, she never enters. So she forces it, and then it gives her risk. And you'll notice what she did. She said, hey, check it out. My stop is just above the 1-to-1s. It could have been even lower. She gets out at the first sign of trouble. Because it's not high probability, she identifies chart reading, something that could create a bounce, and she gets paid right at it. And then after it clears, she says, all right, probably going to the fib. Let me get out a couple ticks above the fib. And if I'm not mistaken, that fib reversed the market. It created a big ugly bounce. So Jen, outstanding trade, outstanding annotation. And guys, I think that it's important to maybe either write into your plan or at least put a note so that you can pay attention to it. If my entry isn't perfect, it's okay to wait for confirmation, right? If it's a little bit off, it's okay to wait for confirmation. But you also have to ask yourself, how off are you willing to let it be? It's got to be just a little bit off. Jen, great job. And then let me find the next one. Dun, dun, dun. I think this was the next one. There we go. Back of price clears trouble, not strong momentum. There is room to the target, not a lot of room, however. Let's discuss. I love that. Back of price clears, momentum on chart, sold at fib, $75, only one lot, as large chart, not odds favorable momentum. You opened up a can of worms, Jen. You said, let's discuss, right? Whew, you're in trouble. All right, so I'm going to translate a little bit. All triggers down after support breaks, right? And I have a clear path to the next fib. That's my initial read on the large chart. And the read is down, but momentum isn't great. And this is where my brain goes. I love this look. Support is broken. Everything is down. The smalls have rolled. I've got room to the next fib. You know what? Let's see if the small chart supports taking a trade. And Jen, this is probably what you did. And this is one of the things that happens, guys. Here's my small triggers. Here's my large triggers. Do you see the separation in between? Momentum is momentum, guys. And Jen, you had a market that is absolutely screaming to the downside on the small chart, and the large chart supports more down. That's pretty good when we weigh out advantages. The only question on these charts, is it worth the risk associated with this trade with only that much room to the fib? How much were you risking? And without momentum on the large chart, What was the likelihood? And I think that with this level of momentum and everything going down, you were able to say the risk is worth it. That little bit of risk with this much momentum, with everything down, with the area that just broke and the next area in sight, hell yeah, I'll take that trade. And I'll get paid right at the very bottom of the move. I love this trade, Jim. And what it is it's you weighing out advantages and finding a way to capitalize outside of the best of the best. The best of the best always feels great, but guys, there's a lot of opportunities in the gray areas. And if you're always talking to yourself in terms of advantages, if you're talking to yourself in terms of what you see and what is good and what's potentially wrong, what happens is you find ways to capitalize outside of the very basics. So Jen, high five. Did that make sense? Did everything I say make sense on that one? I hope. And was I close? Was I close to your analysis on it? Sometimes I get a little wordier to make sure that the people in the peanut gallery get the same idea. So I love this. Here's a strong bottom. I love that. Here's that 50-50. Super strong triggers, potential to break. Everything says up. Will price pull back to here or here? Will there be a divergence? No entering a trade until a pullback. If no pullback, not my money. Was a pullback to yellow 1-to-1, split triggers, didn't make trade risk to reward, not viable for me. And sometimes it's just not your money, right, Jen? But here's the question. Wasn't this a chili dog right there? Odds favorable, back of the bar cleared, 56. Actually, maybe right there. It fit chili dog. I like it. Sometimes it's just not a trade, right? And you talk about why it's not a trade. You know what's fun though? Risk to reward not viable. I love that. Risk to reward not viable. It's okay to not be in a move. It's okay to not take the trade. It's okay to not risk your money if you don't feel comfortable. I like it. And look at that. They came back for you, didn't they? There's your pullback. There's your mid-band inside. Again, you're not interested in that much risk, so you wait for confirmation. And confirmation gets you paid. Great job, Jen. I think you're finding your groove a little bit. And look again, price reversal at fib. No triggers through. I love that. Trust the fibs. Great job, Miss Jen. You're following rules. Almost. Almost, right? Almost. You are. We all break rules. Guys, you're going to break your rules. And the key is, if you're going to fall outside of what's good, make sure that you are erring on the side of advantages, if you will. Why didn't we talk about this one? Oh, that was the 50-50. We did. Never mind. When you break your rules, your heart jumps too much and you hope. Yeah, you can feel it. You can feel it when you break rules. Your body will definitely let you know. I love it. Great trading. Great trading, Jen. And then Cab says, you know what? I can do this too. There's a pullback right to support. Everything begins to roll. 97. So we're about right here. And Cab says, it looks like it's going up. I'm coming off of support. All of my triggers rolled. I've got room to my targets, but it's not perfect yet. It's not a great look. Let me get every indicator on my small chart to agree with the direction. Let me get those small triggers up. And Cav, this is expert entry. This is awesome patience. I love everything about this trade. Not doing anything when it's a maybe. Letting everything agree. And then just riding that wave right up to trouble. Really great trade, Cav. Not a high probability trend trade, but an awesome chart read to find a way to take advantage. And then here we have the 50-50. It breaks up and Cav jumps in right at the top and has to suffer all the way back to support inside of triggers and then gets out just above triggers. And Cav, this is a good one, guys. So let's give a lesson here on this jump in trade. If I just jump into the market here, and the large chart says we're likely to go up, we have momentum, the potential is break. This reversal bar that gets most of us looking for a trend trade entry, you have two choices. You can either exit the trade and look to re-enter when your rules are met, or you could say, you know what? It's easier with everything going on. It's likely to bounce off support and keep your stop down where the market shouldn't go. But very often when these jump-in trades fail and the large chart is solid, they just turn into trend trades. And there's some people that will hold through the retracement and let it ride. And there's some people that will exit and re-enter. But when you know that reversal bar signals the beginning of a pullback, you get to make your choice on whether or not you want to keep that risk. And Cav, I think you did a good job with this one. And I don't think that there's a right or wrong answer. You just got to know what's right or wrong for you. Pete is another guy here that is willing to do that because he understands the pullbacks and the ebbs and the flows, and he's done the time with it. And long downtrend, breaking all the terminations, and you get in 59, 59. I love this. Jen, this looks a lot like your trade, right? It tries to break, and you get that big retracement with weak triggers. And then when it starts back down and everything agrees, Pete just says, here we go. Let me get past the bouncy stuff, and let's straight line this mofo. And he gets paid halfway through because the goal is to get paid. So Pete's already up $300 in his account, and I would wager to say he has no risk on this trade. And then when he closes on the wrong side of the triggers, he says, that's it, I'm out. Let's get out, let's get paid. This is an outstanding trade. Really nicely done, Pete. Guys, he has path. He's just finding a way to capitalize. Steve Diego. Again, everything says down, potential to break. He gets below trouble and takes a quick $200. That is the Chili Dog textbook. And then he does it going the other way. Everything is up, back of the bar clears, Chili Dog to the upside. I love it. Great trading, guys. Same trade both directions. $420, pretty much in the same time zone. Really nicely done, Steve Diego. All right, 10K. We're going to read it. Anything can happen but above the fib. So what's another way to say that? Don't have momentum. Don't have the advantage of momentum, but we do have a clear path. Divergence on the small. So you took it with the reversal bar confirmation on the small. I love this. Plus 11, then got in the hope to move the stop loss after the reversal bar. Should have gone out second divergence and made a little more. All right. I love it. So here's where we're looking. Great job with the arrows. Everything says up. The path is clear, but the momentum isn't great. And this is important. So what 10K knows is, man, my momentum isn't great, but my path is clear. And I have areas, but they're not inside of triggers. And this is the one thing that's important. Once you get below those triggers, guys, here's the bottom of his trigger line at 79, which means that 74 is where his stop would go. Does that make sense? Once you get to the wrong side of the triggers, you don't know where it's going to bounce. He didn't know if it would be the mid band or this fib or that fib, or if it would come down to these 1-to-1s. And 10K said, because it's not perfect, let me get in with confirmation. And again, he knows it's not the perfect trade because the momentum isn't there. He says, let me get out at the first sign of trouble, one contract. And then when that second divergence prints, you're absolutely right. What a great reason to exit, because you've already lost momentum on the large chart and now you've lost it twice on the small chart and you still don't have an area inside of triggers. And based on the location of that stop, it was either break even or it was, man, I sure hope that mid-band holds. And I don't know which one it was. But you could have been out here. Remember, guys, you can always re-enter. You can always get back into the market. Auto break even after 11. Right on. That's great. Great trade, 10K. You managed $110. And do that 4 times every day. See how life turns out for you. Great job, dude. And I think my favorite thing is that you knew your entry wasn't perfect. You knew you didn't have the best momentum, so you forced the market to go in the direction of your trade. And that's your right. Nobody can make you get in at the mid-band. Good job, dude. All right, let me see where we're at. We're running out of pictures quick, guys. All right, Miss Jen. Odds favorable momentum. Clear path. Room to the target. 1 point late. Went to Lou early. Went to Lou low entry. Oh, the entry was a little low. I got you. Went to the loo. I got you. I'm sorry. I didn't mean to make you type that in the room. We don't say loo here unless we're skipping to it. But it's the perfect trade, and you got out right at 1-to-1s. It gave you room. Beautiful trade. Momentum and path. And guys, this is the last picture that's been posted. Momentum and path. How many times have we said that today? Momentum and path. Path entry. Did I, Pete? Was it this one? It sure was. My apologies. Let's read it. Strong bottom, trigs rolled up, separated. You take the first entry at the mid-band. Out at trouble, out with 2 divergences. I like it. And then you hit the fib. And notice that Pete doesn't have any trades into the fib. Pete says, check this out. With this level of momentum, I'm going to make money up to trouble. And then I'm going to wait and see what happens at trouble. And then if it breaks, I'm going to try and make more money after trouble. Nicely done, Pete. Just a little, everything says up, everything's going up, coming from a strong bottom, broke all the trouble. And Pete says, I bet you I could make a quick $600 here. And you did. And you're up 25.20 in that particular account. Trading a 6 lot, 4 lot. So 600 a contract, give or take, 650 a contract. And what time is it? It's 9:38 where I sit, 10:38 on the East Coast. I want you guys to see something. It is not even 11 a.m. in Florida right now. And Pete is 2.5 times on a 4 lot. And I can tell you that's not uncommon for Pete. Great job. I don't care if you're day 1 or day 1,000. You know it can be done. You just have to figure out how to do it. You've got to find your way. There's a way that's going to speak to you, guys. There's a trade that's going to speak to you. It's either going to be the trend trade, or maybe it's that quick profit jump in trade because the large chart leads the way. Some of you will take what we call HVA trades. Some of you will take, whoops, just wanted to put that at the beginning here. I don't know why, OCD. There's so many ways to make money with the software, guys. There's so many opportunities that the market presents every day. You've got to find the one that's easiest for you. My trading plan is nothing but a trend trade. That's all I trade. I trade a trend trade. And I either get my rules met or I don't. But I also trade NASDAQ, so I've got a little more time. But once you understand it, once you build that foundation, I want you to see how this works, guys. This is an HVA trade. This requires a different chart, an additional chart. But it's nothing new. It's taking what you've learned and finding another opportunity in the market. In the HVA trade, first you have to have a good top or bottom. And that's the lesson that everybody learns when you learn the high probability trend trade, that no triggers through termination condition that reverses the market. That's rule number one for this trade. You have to understand termination conditions. Once again, rule number two from the high probability trend trade, defining areas that may stop the market. And then finally, defining your entry point. And the rules are a little different. Instead of areas inside of triggers, we're using a high volume area line right at the triggers. So guys, nothing is different. The idea of this HVA trade is nothing more than taking the rules that you learned in the first trade and translating them to the next level. And the same is true if you decide to take those momentum trades, tops and bottoms, terminations. And then rule number three defines your entry. Your entry is different. Your entry is different for each trade. So don't feel shackled to the high probability trend trade. Don't feel like it's your only trade, your only opportunity, guys. But what I want you to do is once you can talk to yourself in terms of these advantages, you know what's going right on your charts. And once you talk to yourself in terms of advantages, you know what's going wrong. And the better you become with chart reads, things going wrong doesn't always mean that there's no trade. It means that you have to use your ability to read indicators and recognize change so that you can manage it a little more assertively. And that's all that it is. It's that natural progression. But Nexgen has been teaching the same darn thing for 28 years, guys. Identify your termination conditions. Recognize Fibonacci resistance. It's either going to hold or it's going to break, like we talk about every morning. If it breaks, we'll just look for more trend trades beyond it. But if it holds, you have the opportunity for that high volume area trade. And once trend trades are second nature, you may choose to add this one to your repertoire. We've got a plan for you. And then from that high volume area, that's your first opportunity at a reversal in the market. Everything's strong, just trend trade. And keep trend trading until you hit Fibonacci support. And when you reach Fibonacci support, stop. And say it's either going to break or it's going to hold. Let me wait and see. And if it breaks, let's go back to step 3. Let's trend trade some more. And if it holds, you'll do the high volume area the other direction. And guys, this is your entire plan. One picture. This is the same stuff Nexgen has been teaching for almost 28 years. Identify your termination. Either let it break or roll, find your opportunity. The edge trade from 2004. Termination condition, let it roll, find your opportunity. The momentum trade from 2004. With odds favorable momentum, let an area break, sell a snapback. It's been consistent, guys. The trend trade from 2004. When everything says down, pull back to the mid band, look for the close on the correct side. That's your confirmation. Get the hell out of fibs. It's the same stuff. Error a day. Pretty cool, right? Is the sell the pullback to trigger lines or trade to the old HVA? It's very similar to the HVA. So this is long before market flow. This is long before market flow, Morgan. And this was a way, by using the faster momentum indicator, which was really the only momentum indicator then, it didn't break the area. It rolled and it went the other way. John Novak is a genius in recognizing patterns. He said, holy crap, this happens all the time. That should be a trade. And what's cool is you don't ever have to take my word for anything. Let's just scroll back a little bit and see how often it happens. And it won't happen all the time. But there's your termination. There's a little snapback to the triggers right there. No snapback here. No snapback there. There's your termination. There's your snapback to the triggers. There's your termination. There's your snapback to the triggers. It's a little late. And now we're just kind of in a holding pattern. But it's something that repeats itself a lot. Whoops, there's my untitled workspace. Sorry about that, guys. I usually remember to close that. There's your termination. And look at this. It pulled right back to the triggers, which also happen to be a mid-band inside of the large triggers. Pretty cool, right? There it is right there. Termination, snapback. So this is a pattern that Nexgen started teaching in 2004. And there it is. So Morgan, what it looks like on the large chart is this. It's almost always the pullback to your large triggers, right in that area. And this is your patience piece. Because if your large triggers are still down, you don't have the trade. It's all about these triggers roll, and it looks like this. I love the trade. And let's see it again. All I'm doing right now is explaining how many opportunities there are in the market. So there it is again. And do you see the look, Morgan? It's the same damn thing. So imagine if this look lines up with an HVA. Isn't that even stronger? Little confirmation. Doesn't look like we got it here. So, guys, I'm telling you right now, what I give you is the bare bones minimum. What I give you is the smallest foundation ever. What I give you is the path to learning to read your charts so that you can find all of those opportunities outside of the very basic. All right, what are we going to talk about, guys? Y'all been making me work pretty hard lately. Just keep coming up with stuff, Mark. Keep coming up with stuff. So I'm just going to click through all my stuff. Guys, to minimize your learning curve, I can't stress this enough. And I'm going to tell you right now, I've finally grown past the point where I get butt hurt when you don't post in the room, when you don't ask questions. Yeah, we will, Morgan. No, we'll talk about it. Guys, you got to post your pictures in class every day. This is how you get the feedback. Every trade, win, lose, or draw. And if you win and the rules are wrong, you may have a short-term victory, but a long-term failure. How will you know the difference? To be sure, you need feedback, and we're here to help. Guys, short-term victories, long-term failures. One of the most common phrases in this room is, but I made. But I made $500. I know I traded into a termination condition, but I made $500. I know I traded without momentum, but I made $300. And then you disappear for a month. And then you come back and you say, all right, I've been trading into termination conditions and I lost all my money. I've got to go back to basics. It happens. So get that feedback, guys. It's part of what we do. You just got to know what you did right or wrong. For the gap theory, did both large... You only... Oh, I see what you're saying, Pete. So let me show you exactly a great example of that. That right there, and this is what you were asking, right, on the S&P, is my reversal bar marker was right in the middle of it, wasn't it? Yep. Well, the triggers weren't a full bar away. If it's splitting the reversal bar marker, Pete, it's not a full bar away. And the gap theory says that the large triggers must be a full bar away. So it's almost where the language sets the tone for what it is. It's got to be a full bar away. So if it's split, it's not. But it shouldn't have mattered because you had terminations galore here. They have to be above. Your large triggers must be above the reversal bar marker. Your large triggers must be below the reversal bar marker. How many triggers does it take to make large triggers? This is a good lesson. How many triggers does it take to make a large trigger? It takes 2 triggers, right? The same way, if one of the lines of the large trigger is through the fib's not broken until both lines get below. These 2 lines work together. They are one entity. So they have to be below that reversal bar marker. That's when the gap theory is in play. That's a great question, Pete. It really is. And guys, if you want to study that gap theory, there are all sorts of pictures of that gap theory in there. And all it does is it says, hey, price returns to the large triggers. When they are a full bar away, it's more likely to do it than not. And you can go back and study it. Here it is. Price reaches the midband. Large triggers were a full bar away. And sure enough, it closes the gap right to the large triggers. And price reaches resistance. And I guarantee at the time of impact, these were a full bar away. By the time price got back to it, it was a tick off. But there it is again, closing the gap. There's your midband, closing the gap. Bob, I don't give recommendations, ever. I don't give recommendations. But what I can tell you is that we are hopefully a week or so from going live. Hopefully. It's all dependent on programmers. But Nexgen my brother's been working with programmers for the last 9 months. And everything is secured and ready to go for Nexgen's funding company. Pete uses Take Profit and Perdia. And remember that the internet is the internet. For every 10 bad reviews somebody gets, there's probably 100 people that love it but didn't say anything. Usually the only people that post reviews are the people that are angry. Have you ever noticed that? After 30 years in the restaurant business, I can tell you that's true. Nobody ever called me up to tell me what a great time they had in my restaurant, but everybody called me up to tell me when something went wrong. But Nexgen is working on a funding company. He's working on a standalone browser version that you'll be able to use on your iPad, on the beach. All of this is in the works. I have an account with Take Profit. Or no, I have Top Trader. I have an account with Top Trader. I've had accounts with Apex and never had a challenge with them. So everybody's experience is going to be different. I don't make recommendations. I encourage you to do your research, do your due diligence, and make your own decision based on what your research points to. How is that for not giving a clear answer on what you should be doing? But I mean, that's it, right? Do your due diligence or listen to somebody that you trust. Whatever makes you happy, makes you feel comfortable. And remember, guys, that prop firms are where you test your plan. Prop firms aren't where you learn your plan. And my brother's going to kick my ass for saying this to everybody because they make money from you trying to learn your plan in their establishment. I want you successful, guys. I want you successful. I want you to simulate, to practice, to make mistakes, to get feedback, to get better, to build trust. And when you feel like you're in that position that it's time to practice and go live, that's where the prop firm is. And you go in and you find out how you're going to react when the pressure's on. And then, if you pass that exam, you're really going to learn how you react when the pressure's on, when there's money on the line. So remember that. I've seen people that don't have rules get 20 accounts, 20 prop firm accounts, and link them through copiers and blow out 20 a day over the course. And some people just have too much money, I guess, and that's okay. I've watched people lose $15,000, $20,000, $30,000 a month for 2 or 3 months straight with prop firms. That's hard to do, guys. So remember, you're testing it. Guys, there's that picture of when there's nothing to do, huh? Can't go short in determinations, can't go long in determinations, can't go long against momentum and trend. It's just a mess. Let them work it out. Jen, do you suppose they will work it out eventually? You think they'll break out of that range, or is this it for the rest of the S&P? Probably when you walk the dogs or go to the loo. I love it. I'm going to start using that word. Right here. Oh no, I'll never get paid. Right here, I got paid. Right here, I'll never get paid. Right? Guys, it's over and over. It's going to go through this. We all have that little angel and devil on our shoulder, right? The angel says, wait for your rules to be met. It's coming, it's coming. And that little devil's like, oh, Jen, if you don't take 17 trades right here, how are you ever going to make money? And sometimes we listen to that voice. We almost always listen to the voices in our heads. So keep it positive. Crude's doing the same thing. So let's go do chart reads. Here's the S&P. Triggers, no momentum, no clear path. I can't think of anything to do there. Crude oil is coming off of a termination condition. My smalls are breaking below the large. All of my trigger lines are below the areas. That's that snap back to the small triggers, isn't it? There might be some people thinking, man, if I get a conversion, some sort of confirmation bar, right? Let's just see. That's the pullback to the small triggers. I don't know what risk would have to be on this. We'll give it 50 bucks. Termination, triggers roll, snap back to the small triggers, down and strong. And it didn't work. There you go. But that one might have fit the bill. We probably want it up here though, because I don't have momentum to push. Does that make sense? I might have lost that one. I might have waited for a reversal bar. But you got to be able to go through, and all you have to do is talk about your rules. Are my rules met? Do I have rules met? Is there something going on that says I have more advantages than disadvantages? What am I willing to risk? Does it fit my plan? Take the trade. You have your small chart closed on crude because the big chart sucks. I love it. And Pete, I give you credit for that. I think that is one of the greatest things you could ever do. Don't let the small chart seduce you. It is the siren song. You will crash on the rocks, right? Just watch the large chart. I think this is great. Because it's easy right now to say there's nothing to do, right? But if you start looking at that small chart, you start saying things like but. Thank you for that, Pete. Good stuff. All right, guys, I'm going to walk away for 5 minutes. When I come back, if you guys want, we can talk NASDAQ. So if you have NASDAQ specific questions, let me get this loading up for you. And I will be back in a few minutes. And we'll take a look and see what's going on and what we can do and what we can learn. Small chart fear of missing out. Amen. I'll see you guys in 4 or 5 minutes. That's a whole lot going on in only 2 minutes. This is why the NASDAQ isn't necessarily the best option for new users. So, who are my NASDAQ traders in here, and what are you wondering? Looks like termination conditions work, don't they? It sure looks like you still have areas that could stop the market. You've been on NASDAQ all day, been a good day? I like it. Looks like price still returns to the large triggers. Looks like momentum still has the potential to break areas. Looks like you know exactly where the areas are that could stop the market long before it gets to them. What's the difference? It's just the speed, right, Morgan? It's just patterns. The only difference is the speed. It's fast, guys. There's a lot of giddy up in this market. So let me know what your questions are if you want. There's crude oil, stuck like Chuck. There's the S&P. The trend is up, the triggers are up, but the path isn't clear. Look how rule number 2 is defining where that market needs to break in order for me to feel comfortable. How can I take a trend trade if there's no trend? Right is not a trend. So guys, what do you want to talk about? This is it. So I'm not even going to end class early. Yeah, me too, Jen. I still do every now and then. They still get me every now and then. Since we are out of pictures, guys, I can kill YouTube and just mute everything and wait for a question or a picture. Or we can have an hour and a half of awkward silence on YouTube. There's no trades that I avoid, Morgan. Thank you for saying that. Why would I avoid a trade if the rules are met? Right? So, does an HVA trade work on the NASDAQ? Absolutely. Does a momentum trade work on the NASDAQ? Absolutely. Does a trend trade work on the NASDAQ? Absolutely. Does that white bar trade work on the NASDAQ? Absolutely. There's no trades that I avoid. None whatsoever. The only thing on the NASDAQ where I change things up a little bit is the entry for a trend trade. There's 2 options on a trend trade. And on the NASDAQ, in my opinion, and ladies and gentlemen, if you're not trading the NASDAQ, please understand this is NASDAQ specific. The difference between the large chart and small chart on the NASDAQ versus the large chart and the small chart on, we'll just say, the S&P or crude oil, is your large chart on the NASDAQ is a 34.5. It is 3 times larger than your large chart on the S&P or crude oil. Why? Because the NASDAQ moves about 10 times faster. This right here, let me get back to the timestamp. This is the last 10 minutes on the NASDAQ. I got it, Steve. There was plenty of recording yesterday. There was just no volume. Guys, this is 10 minutes on the NASDAQ. It moves a lot. So there's a 34.5. And then your large chart on the NASDAQ is the large chart on all the other charts. Or the small chart, your entry chart on the NASDAQ is the large chart on any other market. So there's a little difference in the trend trade entry. So when my rules are met on the large chart, when the 34.5 on the NASDAQ says that I have odds favorable momentum, when the 34.5 says that I have a clear path, right? The rules don't change, guys. The high probability trend trade is always the high probability trend trade. There's two things that are going to happen when price pulls back to an area inside of triggers. There's two looks that you're going to see. The first look, and the most common look, is that your small triggers will be less than a full bar away. What does that mean? That means that your small triggers, let me see if I can find it. There we go. I'm looking for a short trade, but my small triggers are less than a full bar away. So there's a good picture of it right there. I did this so we can get the recording in it. This is in the spreadsheet that I give every day too, guys. So Steve Diego, do you see how the small triggers are not a full bar away as price pulls back to resistance inside of triggers? So that's my look. That's my heads up that says, okay, wait for a close on the correct side of the triggers. Don't fight that fast momentum. And Steve, you know that when you're on this side of those small triggers on the NASDAQ, that's what makes your chili dog easy, right? That's what pushes you to profits. It's the same thing that can keep you from profits. And one of the things that you'll notice, look how those small triggers almost behave as resistance when they're less than a full bar away. So by waiting for the close on the correct side, what you're doing is you're getting to the other side of that immediate momentum, and you're doing it right at the areas that are likely to hold it. And guys, this is it. If less than a full bar away, close on the correct side. But if I get to the area, and those small triggers are above the reversal bar marker, I'm going to get in at the area because it's going to mean that once I get a reversal bar, I've got virtually no risk. And if those small triggers decide to hold and stop the market like they did here, well, it's a very manageable trade. And I've got time to react and I've got time to do that. So those are the two. And I've got some pictures in here. And this was a good one. You never got a close on the correct side of the triggers. So you never took a loser. And the same is true here. Never got a close on the correct side of the triggers. Didn't take a loser. And you'll see a lot of those in the NASDAQ. And man, I went through a lot of troubles. I went through a lot of accounts learning this lesson for you guys. So just for grins, let's go look and let's see. Potential to break. So we'll go back there and see what it looks like. Whoops. Triggers were almost a full bar away. They acted as support, came up. If you waited for the close on the correct side, it was easy money all the way down. That's a pretty good example of it. And it means that you're paying a little bit for that confirmation. If you wait for the close on the correct side. What white dashed line, Hamed? This one? Do I have one on my chart? Help me out. On one of the pictures, this right here, it's just a 21 EMA. That's all it is. It's just a 21 EMA. This is a part of the ale class that Janesh teaches, and it's just a part of the setup. It really doesn't factor into taking trades on the NASDAQ. But because it's on my personal charts, you're seeing it. It's not anything that you need to be able to take a trend trade on the NASDAQ. It's a part of a completely different program. You're welcome. But it's a 21 EMA is what it is. I don't have a rule for it really. I need momentum. I need clear path. And guys, that's kind of it. With the NASDAQ, everything else, a trend trade is a trend trade, and a momentum trade is a momentum trade. We'll see what that one looks like. And that little trick with not fighting the small triggers has always made things easy, or easier. There's your first area. Small triggers are too close. If you wait for a close on the right side, it's a little bit of risk. It's a little bit of risk, but man, you're on the good side of the trigger lines at that point. Same thing here. Easy money. First one doesn't hold. Second one doesn't hold. Close on the right side. Off it goes. Right down to the area. Close on the right side. Off it goes. So guys, that's NASDAQ specific. It really is. That's a NASDAQ specific look. Other than that, a termination is a termination. Strength is strength. Weak triggers are weak triggers. Just the NASDAQ moves 10 times faster. Does that help? I hope that helps. You have to be so in tune with your rules to trade the NASDAQ. You have to know exactly what you're looking at. And you have to be a little predictive, almost. You not only have to know your patterns for entry, but you've got to learn the patterns that precede them. I love the NASDAQ. Look at this pattern. This is pretty cool. I get to do this about 2 or 3 times a week, or a month. I'm sorry. Okay, here we go. Sorry, Dima. Thank you for that. When we do one up, one down technique to enter the market, let's say we're going down, so we have several bars down, then we have a bar up. When is the time to enter the market? Right after the up bar formed? Or do we need to wait for the down bar? So you're talking about, Dima, with the market flow chart, right? On that one up, one down pattern. And I want to make sure that I'm clear on that. Let me see. Cool. So let me find a market that has some momentum. We'll do NASDAQ. Let me build a range, or a chart real quick. Let me get my range chart built for the NASDAQ. And remember, it's not an 8 range like it is on other stuff. It's actually a 21 range. Nope. Range chart, 21. All right, let me get this up right now, Dima, and we'll take a look at it. And there's a couple different things. So while that chart's loading, there we go. Let's go find the pattern. And we should see one in here. Of course, first we want momentum, right, Dima? But there it is. One down, one up. One down, one up. One down, one up. It happens a lot. So if I'm going to use it for entry, well, I still need something to bounce off of. So I love using it for those momentum trades for entry. There's my one down, and then there's my one up. So you can enter. I don't know that there's a specific rule for entry using it, to be honest with you, Dima. I use it, and let me show you how I use it. And I know John Novak teaches to use it for momentum trades. So first and foremost, rules have to be met, right? Rules have to be met. So what are the rules? It's a momentum trade. Are you trading the momentum trade taught by Nexgen that says for the momentum trade, you need a little snapback to an area? That is an HVA trade. Hold on. little snapback, right? Momentum trade. And that has several into it. So you could do it one down, one up off the area if it's close enough and use that area for your entry. You could say, okay, everything says up, there's my down bar. I'm just going to go ahead and buy. And what happens, Dima, is these bars have boxes around them. Let me blow this up a little bit. So if you know you want to enter on the one up, one down, right? When the second bar starts to print, the box is like this. It's from the base of that bar, 21 ticks down. And then as it moves up, so does the box around it. Does that make sense? So you could buy anywhere in this box. You could wait for it to form and give you the up bar and use the base of that bar for a stop. You could say, okay, it's coming down. I'm going to get in at the area. I like having areas to trade from. And then what I'll do is my initial stop will be below the box. And as price moves up and the box moves up, I'll move my stop up behind it. I'll just trail behind it. Once the bar is formed, my stop's in place. Does that make sense? So I think that the entry has a lot to do with what you want, how much risk you're willing. Do you want it to confirm the up bar? Do you want to catch it halfway in the middle of the box? Or you want to catch it from the area? Like there's a million ways to do that one. And since I don't trade it, and it's not actually something that I have a plan for, I'm just going off what I know. The way I use it, Dima, is if I get in right here, if this is my long trade and my target, I'm saying to myself, that's where I expect the market to go. What I'll do is I'll use that up-down pattern and I'll use that box that's created and I'll use this for stop placement. So what I'll do is when the down bar prints, I'll put my new stop where that second down bar would print. And as it goes up, I'll trail it, and then that's my new stop. And then the market continues up, and I want to hold for the bigger move, and I get that down bar, and then there's my box where the second down bar would be, and I do the same thing. And I'll use that up down to trail. If I'm going to use it for entry, I want it to be a rules met trade on my Renko bar charts. I want it to be that momentum trade, which means that I want to see it coming from areas. And I'm going to use those exact same areas. And I know that was a lot of talking. John Novak may actually have a plan. I'll ask him. Let me send a little message right now. Right on. You did send him a message? Cool. There it is right there again. There's your up and then there's your down. Notice that it lines up with the area. But the most thing is to remember that it takes momentum. It takes momentum. And the Renko bar chart's really telling you that it's time to go. There was that termination condition. Everything went down. There's your up, down, odds favorable momentum. Up, down, up, down, up, down. And then it changes right at Fibonacci support. So good question. I'll keep that range chart built just in case. I'll keep it off to the side and do things with it. And I just sent him a message as well. So if he gets it over to me before he gets to you, I will share it for sure. I don't always have all the answers. I can usually get you close, but I will always reach out to the person that has the answers. and we will be good. Good question. And that's something that you can use on any of them. I like using it for bigger moves, or I did. I don't even have a range chart now when I trade. I see a lot of value in the range chart. I'm a big fan of market flow. It just happens that the plan that I'm trading is one trade, and I don't need it for what I'm doing based on the education that I received in my trading plan. Look at that termination. Oh, that's what I wanted to show. And you know what? Let's do this. Hold on. I do sound effects, sorry. This pattern right here. And this is NASDAQ. And today, whoops. And today is 121.25. And then if I go to the education page and I go to termination conditions, this is why I talk about patterns so much. This is crude oil 2021. I don't even know what the exact date is. What do you guys think? That's pretty darn close, isn't it? Straight to resistance, all the way back to support in a mid-band. Large triggers don't follow. Goes up, retests the area, creates a pivot stop out, and that's where your reversal happens. This is why I say the same thing every day. This is why we talk about patterns. Why we don't talk about news releases or elections or the orange juice crops freezing, right? The market has a memory, and the market does the exact same thing over and over and over. And once you begin to recognize those patterns, you can begin to capitalize. You can say to yourself, I've seen this look 100 times. In 70 times, it went down and reversed. Let me find a way to take advantage of it. Let me find a way to take advantage of that pattern. But it's funny because if I went through my picture catalog, I guarantee there's no less than 30 or 40 pictures that look just like this, because it's something that happens all the time. What would you guys like to talk about? Any other NASDAQ questions? I think really the entry for the trend trade is the biggest one. The entry for the trend trade is the one that's going to pay the highest dividends. Crude oil is just, man, they're stuck. Look at that. S&P's trying, aren't they? They're trying to get through that area. They've given it 1, 2, 3, 4 shoves on the small chart. Haven't done it yet. Who has a written plan? Who, if I said there was $100 in it for you, if you emailed me your written plan, entries and exits right now, who could do it? Anybody? Most people can't. And it's okay. You don't have to answer. One of the things, I met a gentleman, he's been with Nexgen for decades, very talented trader. And he told me, he goes, Mark, I spun my wheels. I spun my wheels for years until I actually wrote a plan. And once I wrote a plan, I had something to follow, and I learned how to follow it. He goes, and that's when I found success, and that's when I started finding my next trades. Not having a trading plan, I think, is one of the biggest challenges that we create for ourselves. Leaving our entries and exits to emotion, to fear, to greed, to adrenaline. Keeping it very, very pragmatic. And the sad thing is sometimes when you have a plan, you have to take an entry that goes against your gut. And you have to take an exit that goes against your gut, which is why your plans have to be well tested, which is why your plans have to be established and proven and verified. NASDAQ, odds favorable, potential to break, back of the bar clears, you have room to the fib. So you take it with all the momentum and you get out at the fib. 2 contracts off. I'm assuming that's 200, not 20. 7-second trade. Steve Diego, it's gorgeous. A whole lot of doing nothing, and then your rules are met, and you capitalize. It's perfect. And it's consistent. And guys, this trade is dependent on momentum and a clear path. This is that chili dog trade. This is that trade, and Ron's not in here today. Hope he's okay. He split early. This is that trade that's based all on the idea that decisions are made at fibs. That decisions are where the people that control the market are most likely to make decisions. And if those tails are the pullbacks on the smaller, faster chart, I want you to see something. This is what I do. Like, I try to explain it in fables. I can't. I've signed an NDAs, you know. You have them. You have my rules. You took the ale class, right? I just want to make sure. I'm pretty sure you have. You did? I'm going to DM you. And I'm just going to catch you outside of this classroom so I don't get in trouble. So after class, keep your eyes open over there. Cool? Awesome. No worries, man. And remember, Gino, I didn't get the full class. I got about an hour of Janesh's time, and then I built a plan based on what he taught me. So it's going to differ from yours a little bit, but I'm always glad to share. As I want you to see in this picture, reaction from the fib. There's one of those tails right at the fib. Reaction from the fib. Reaction from the fib. Tails at the fib. Reaction at the fib. Tail right at the fib. Reaction. 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 Oh my gosh. More reactions and over, guys. Decisions are being made at these key Fibonacci areas. Decisions by the people that control the market are there. That's what creates those up and downs. That's what creates those tails. That's one of the reasons why on that trade that Steve takes, he'll tell you, I need the back of the bar to clear trouble. I need the back of the bar to get away from. I need all of my price action to get away from that decision-making point, because stuff like this can happen. And when it happens, he takes advantage right to the next decision-making point. And I really do. I love everything about that trade, Steve Diego. The execution is awesome. And the fact that you didn't hope, and let me do this as well. We talked about understanding where the market is likely to go and using it for intelligent profits. Guys, I want you to see his target right on top of a red fib. And if he had put 1 ounce of hope that that area would break, if he had said, you know what, I'll just leave 10 ticks on it, because what if it breaks? He's out. Instead of $200, he's break even. This is the advantage that Fibonacci gives you, ladies and gentlemen. You know precisely where the decisions are most likely to be made, and you can respect them 100%. You can force them to break, and you can choose to do nothing. And I get a little preachy. It's like the sermon when I do this. But I can tell you right now, rule number 2 is going to keep you out of a world of trouble. Trading into these areas are avoidable losses. And it will break every now and then. And you'll feel like you missed out. But you have to go back and you have to look at those termination conditions. You have to study those termination conditions. and you have to say to yourself, man, it held 36 times and it broke 6. Where does my advantage lie? That's how Nexgen has built these plans for you. The optimizing your chance of success, giving you the highest chance of success, getting in and out of the market. That's how it works. What would you guys like to talk about? What's on your mind? You want this picture, Marlon? I'll sell it to you. At some point, our paths are going to cross. I want a shiny nickel for that one. There you go. These are the pictures I take. Guys, pictures of when my rules aren't met. I love taking the pictures. And I have the benefit of understanding where Nexgen came from. And I have the benefit of knowing that my brother spends 20 hours every week on market replay, studying patterns and entries and exits and management and things that can be produced into trading plans. And I have the benefit of knowing that he's done that for the last 30 years of his life. So I've got trust. I believe in it. I know why rule number 2 is a rule. If you go through and you start taking pictures of termination conditions, and this goes back to the idea of the spreadsheet, right? If you go back and you take 80 plus pictures of termination conditions, what is the likelihood that you won't believe in them, that you won't trust them, that you won't want to avoid them because you know that they take problems? Cav, as soon as it's perfect, and I wish I had a more specific answer. Cav asked, when is this prop firm going to launch? As soon as it's perfect. The other thing about John Novak is he's not going to drop a half-assed product out there and hope it works out. He has a team of programmers. I have been, along with John Novak, working diligently using TradingView, and we have written and created plans for people that aren't using NinjaTrader but still want to take advantage of the indicators and the ideas and the patterns. We've been working on this a lot together, writing plans. We have been going through and using AMP trading. Let's see. Never mind. So he has a 20-year relationship with AMP Trading, and he's going through with them, and we're using data, and we're creating scenarios, and we're doing all these things. Oh, I love that. The market doesn't care about your position. And we're as close as we know how to be without being there. But we're not quite there yet. There's still a few little things that we need to work through. We need to make sure that when you guys get charged, you only get charged once. That when you get funded, that everything does what it's supposed to do to get you funding. And that we can monitor everything that you're doing, entries, exits, stuff like that, to make sure that you're not violating rules. So there's a lot that goes into it. There's a lot more that goes into it than I ever dreamed. But we are very optimistic that it's very soon. We're starting to use the word soon a lot. We're starting to use the word soon a lot. So we don't have an exact date. I can tell you that I have been funding and blowing out accounts on TradingView for the last 2 weeks, gathering data for the programmers. That's what I've spent almost every afternoon doing. That John Novak and I are coming up with documentation, that we're coming up with trading plans, that we're coming up with user guides, that we're coming up with frequently asked questions, all those things. It's close, Cav. I'm excited. I can't wait. I'm so stinking excited. And with that is the browser version coming. That idea that you can open up Google, right? You can open up your browser, Chrome, whatever, and let's see if I can show you on TradingView. See if it'll do it. And you open up TradingView, and you'll be able to open up our browser just like this. And look at this, guys. I've got the NASDAQ rocking with triggers, with one-to-ones, with mid-bands, with market flow. Right in my browser. This weekend, John Novak and I went through and we started doing it on our iPads and on our phones, and it was pretty cool. Let me see if I can find that picture. It's so exciting, Bob. Man, John Novak and I trade a lot of pictures. That's kind of funny. Here we go. This is the one that I was going to show you. That's my iPhone. That's mid-bands and triggers and one-to-ones and divergence and HVA and market flow. Guys, that's my iPhone. John Novak wrote all the code, got all the code to replicate. The only thing that he can't replicate is Renko bars and fibs, and that'll be on the browser version. But you'll be able to do all of that right from just the browser. It's awesome. Super excited about it. Super excited about it. All right, what time is it? Man, we still got time. Look at that. 1, 2, 3 divergences in the same price range. You guys remember when I said that 3 divergences in the same price range can behave as a termination condition? The buyers tried to push up. They had momentum. It had the potential to break. 3 divergences and kabloo. Down it goes. Amazing. Good top. Odds favorable. Potential to break. There it is. There's your 50-50 trade. Isn't that awesome? That one fit the rules too. So many great things happening, guys. So much exciting stuff going on with Nexgen. Can't wait. Can't wait. Nexgen Mark's in here. That's cool. You guys think that's me when you see the name, but he's much cooler than I am. Chris Novak's in here. He's the best looking Novak out of all of us. I know you guys work with these guys. They're excited too. Cam's in here. He's honorary Novak. We tried to change his name. He wouldn't let us. There's those darn 3 divergences again, ladies and gentlemen. There's those darn 3 divergences again. Can you speak to trading your own money after a solid month of successful simulator? Yeah, Bob. Well, here's the one thing I'm going to tell you is that I'll probably never trade my own money again. I'll trade somebody else's. I can pay $50, $100 a month and have access to $50,000 of someone else's money. But let me speak to that real quick. And it's cool because this really hasn't ever changed, Bob, be the man. So let me go through this. I talk about the first 3 every day in class. And let me go to the rest of them. So the blue box there says after class before the next day, download replay data for that current day that you just finished trading. That's just increasing practice, right? Creating trust, repetition, retrade, take pictures, and then here we go. The gray one down at the bottom, Bob. Repeat the process every day until you always take the correct trades. And I think that this language is very important here. And I don't know that my brother knew what he was doing when he put it, but it's brilliant. Bob, if your pattern, if your rules have been proven to win more than they lose, right? And you've gotten to a point to where you're following that plan flawlessly. You're taking the correct trades. You're guaranteeing yourself that you can win and trade live money. You're proving to yourself that you can take the right trades, that you have that statistical advantage. So when you can do this, 30 days is a great number. There is no real number. There is no suggested number. But once you guarantee yourself you can win, sometimes, most of us, if you're like me, I guaranteed myself I could win right at 30 days. But the problem, Bob, is I hadn't won, except for some lucky trades on Simulator. And that's when you trade a prop firm. That's when you trade live money. But what's important that you remember is that what you're doing when you go live is you're testing your ability to reproduce results in an environment where there is real risk. And Bob, I'm not going to lie to you, so many people go live and they pucker up and they break their rules. And they move their stops, and they skip their entries, and they make mistakes, and they hope, and they wish, and they want, and very often they blow out. And it used to be back in the day, you would lose $5,000, $7,000, and that was a very expensive lesson. And they used to say, oh, if you don't have 20 grand to lose, you can't be a futures trader. It's just not like that anymore. You can lose 3 grand if, like on Apex, you can get a $50,000 account for $50 or whatever it is. I don't remember what it is. And the loss limit is $2,500. So instead of losing $2,500, it costs you $50 to lose that $2,500. And then you have to reset. And then you can lose it again, right? It's only another $50. The idea is that if I guarantee I can win, and then I go live, Bob, and I can't. I guarantee on Simulator that I can win, but then I go live and I can't. I have to analyze what went wrong, right? So what did I do? What changed when I went live? And these are the things that happen. The first one, and probably the most popular one, is I stopped following my rules and tried to make money. What did I do? Did I just lose you guys? How did I bump everybody? Guys, oh my gosh. I'm so sorry. I don't know what happened. I think Discord just booted me. Can you guys hear me? Okay, cool. So we're gonna do a little something here. So top reasons I've seen in my experience people lose money when they go live. The first one is they stop following the rules and they try to make money. They stop worrying about the patterns that have been proven to produce results and they focus on the dollars in their account. That's one of the biggest things. And then not trusting their plan. And there's kind of a little subculture on this one, which makes them skip trades because of emotion. It makes them move stops. It makes them change their whole game plan because they don't believe in their plan. And guys, I'm telling you right now, when you believe in your plan, it's difficult to break outside of it. It's difficult to want to not take a trade. It's difficult to want to move stops arbitrarily. So if you jump in and you do lose money, you're like, okay, I'm live, here we go. And then let's just say you blow out first day, right? You've got to go back and look at those pictures. So just because you've gone live doesn't mean that you're not tracking pictures anymore. You've got to go back and look at them. And you've got to say to yourself, what am I doing? What changed? How was I so successful on Simulator, but I'm struggling live? And it usually is a focus on the money. Hey, Cav, have a great one, man. Great trading today. It's because you deviate from the plan that's been proven. So if that happens, and this is where I'm going with this, if that happens, if you go live and it doesn't work out the way you wanted it to, and it's okay if that's the case, it is okay to go back to sim. It's okay to go back to a sim and reinforce those rules, right? Even if it's a week. Hey, let me go back to sim. Maybe you tried to add a new trade that you didn't fully understand the rules. I did that when I started trading the NASDAQ. I did it in those prop firms, and I blew out like 15 of them because I hadn't figured out that thing about not fighting those triggers at the areas. That hadn't worked its way in yet. So guys, it's okay to backstep. It's okay to do that. I can't believe I bumped everyone out of this room. Half of them are like, damn it, Mark. Learn your plan, trust your plan, practice your plan, test your plan, follow your plan. That's it. It all goes back to the plan. Does that help, Bob? Bob B. Was that Bob B or Bob? That was Bob. That was Bob B, the man. They're both Bob B's. So yeah, when I like 30 days. So my new plan that I trade right now, I gave almost 60 days because I wasn't just learning a new pattern, I was learning a whole new concept. And by learning that new concept, I had to go through it and I had to learn to trust it. And that took me at least 30 days to build trust in the ideas that I was trading. And then I had to give myself at least 30 days of making every mistake I could possibly make so that I could become comfortable and know what I was looking at. So, yeah, that's kind of the long and the short of it. There is no time schedule. And I'm a big fan. For me, $50 is worth testing a plan that I feel comfortable on. Because what it does is it shows me where I'm vulnerable, if that makes sense. It shows me where I'm most likely to make my mistakes because I'm making them. And guys, that's where this classroom pays dividends. So many people go live and refuse to come back and participate. Because, well, I'm live now. That classroom isn't for me. Guys, I don't care how far you are into your career. This classroom is always for you. This classroom is always a place where you can come, where you can get feedback, where you can get help. You can email me, you can direct message me, you can send me your plan and go, hey Mark, here's my plan. What do you think? And I will say things. There's someone in this room that sent me their plan recently, and there was just one little word. I don't even remember what it was, but there was a word that was ambiguous, and I said, let's make this specific. And he was like, oh my gosh, yeah, that makes sense. And those are the things, guys. This Nexgen it's never ending. The education's never ending. The support is never ending. The only people that end it are you guys. So don't do that. You don't have to. All right. Sorry I booted everybody. I feel horrible. I'm going to kill